Good evening and welcome to the Audit Committee for November. Take the first item on the agenda, which is apologies for absence. Steve.
We have apologies from Councillor Tijan.
Thank you very much.
Councillor Turpin was supposed to be substituted.
Yeah, unfortunately, Councillor Turpin has a family issue at the moment. He says he might be here, but we can understand that. Take item 2 of the agenda, which is a record of the meeting. Can I sign the record of the meeting held on the 5th of October 2022 as correct? Agreed. Thank you. Item 3 on the agenda, which is urgent matters. There are no urgent matters this evening. Item 4 on the agenda is declarations of disclosable pecuniary interests or other significant interests. Are there any declarations of interest? Councillor Golding.
Yes, I'd like to declare an OSI. Whilst it's not directly mentioned at all in the report, but of course we're talking about the Treasury management strategy, and as MDC is funded via that, so I think I better declare an OSI in item 5 because I'm a director of MDC and I chair MDC's Lands and Projects subsidiary. And I have a dispensation from the Council Conduct Committee to speak and vote on MDC matters. As I say, although it's not explicit in the report, it is implicit.
Thank you, Councillor Golding. Take item 5 on the agenda, which is the mid-year Treasury report. Please note that there is a typo in the report title which refers to 2021-2022 rather than the financial year, but it is for the financial year. So I will ask Jonathan Lloyd to introduce this report.
Thank you, Chair, and yes, I do apologise for that typo, which I only spotted on Monday as I was making my notes together. I thought, how on earth have I missed that all the hundreds of times? I must have read it, but there we are. Anyway, this report sort of follows on from the outturn report that you had just a few weeks ago. So this just updates us on where we've got to so far in the year. As always, we are continuing to try and balance the needs between trying to create a smooth maturity profile for the debts that we've got and whilst trying to keep the cost to a minimum for the revenue account. That's led us to continued use of short-term borrowing, which of course does leave us slightly exposed to interest rate risk. At the outturn report, I reported that we'd got £70 million worth of short-term borrowings, which is that was as at the 31st of March 2022, and of that 35 million was repayable by of that 70 million, we were at the time that this report was written, we were down to just 35 million of that remaining, and since writing this report, that figure has come down to 20 million pounds, and these changes are as a result of a combination of repayments that have been made, and also where replacement loans have been secured, but effectively those debts won't now be repayable till a much later date. The borrowing overall remains within the limits set by the CFR, the capital financing requirement, and we do still aim to keep borrowing as low as possible, which means that cash invested will also be low, and that also means that we don't get very good rates on that cash, but it is just basically day-to-day cash. Details of the investments are shown in 5.3 and 5.4. The rapid rise in interest rates have led to an expectation of an overspend on borrowing costs, but the extent of the damage now depends on how quickly capital expenditure takes place, and therefore the extent and timing of new borrowing. Provisionally estimate provisional estimate was 700,000, and that's quoted in paragraph 5.5. Our benchmarking shows that investment returns remain within expectations, and in the graph at 5.7.1, Medway is the heavier leftmost mark, just above the red line of the graph there. I don't have any further immediate comments, so it'd be open to questions, and I've managed to get through that without even mentioning Lobos.
Thank you very much. I'm going to open the floor now. Councillors, any questions?
So, thank you very much. I was going to raise, I know we spoke about Lobos last time, and no doubt I will this time. The first question I have on Lobos is that have we had any comeback from any of the providers on those? Because clearly, as interest rates now change, some of the providers might seek to redemption, especially if they've got capital problems themselves, which some of the banks I am led to believe might have. So, but it might be the case we haven't had any update. So, the second question is just around, and I appreciate our short-term borrowing has gone down from 70 to significantly lower numbers. However, with the interest rates predicted to go up even further over the next 12 to 18 months, if you look at predictions and futures, are we now seeking to perhaps, instead of short-term borrowing, seek to one big, and I asked this last time as well, a more longer-term sort of loan, perhaps a larger sum, if indeed we need that from a cash flow perspective. And just my third question, just around the capital finance ceiling is kind of an artificial limit, as I understand it, that we sort of can set ourselves. The question I have is just in terms of just the overall size of the organisation in terms of turnover. I don't know if you can answer this, but in terms of our debt to turnover ratio, what is currently the proportion of the amount of debt we are borrowing to our overall turnover? Because that to me that's how we would calculate it in the private sector. We look at how much debt you have versus how much cash flow you have potentially coming in, or your organisational size. I mean, what with all the capital investment we've made, what is that looking like at the moment?
Okay, thank you, Councillor Osborne. I'll try and take those one by one. In terms of Lobos, I did have an exploratory phone call from one of the banks about a week ago, but this was very much exploratory, and they were kind of fishing, I think, as to whether we would be willing to repay, and I just said that it would depend on the figures. I mean, last time we had an approach, the figures that were presented to us were just not attractive at all. So until we've actually got something firm on the table, obviously we would consider whatever came our way, and whether it was in our interests to do an early repayment or not, to refinance it in another way. So it's until we get something, there's not much we can do on that. You asked something about interest rates and cash flow, and whether it was worth us taking out, a big chunky loan, basically. The difficulty I have with this is in being able to predict our cash flow that accurately over such a period, and this really comes down to not only what is in our capital programme and how big it is, but when that's going to happen, and indeed whether it will all happen or be rescheduled or what have you, because obviously when you do borrow money, there is a cost of carry while in between you actually taking out the loan and actually using it. You might be borrowing at 4 or 5%, and investing it at 2% while you wait for the bills to come in from whatever it is that you're doing, and so that needs to be taken into account. Obviously, we've got the capital strategy coming up, and that will help to inform those decisions. And obviously, I will be liaising with the Chief Operating Officer on that, and we'll come to a conclusion. You asked, you said something about us having an artificial ceiling. I'm not quite sure whether you were referring to the capital financing requirement, which in effect, your capital financing requirement goes up because you've decided you want to finance something from it. So in that respect, yeah, yes. In terms of the debt to turnover, I don't think I recalculate the figures in this report, but in the annual report, in the annual strategy, we always look at what the ratio of the debt costs to net what's the expression? Net income of the authority. And we do that both for the HRA and for the general fund. So we look at rents on the HRA, and we do publish those, and they've always looked relatively healthy, but it's all a matter of judgment and what members are comfortable with. I don't think I've got anything further I can add to that just at the moment.
Thank you. I've got a set of questions on borrowing limits, which I'll take first. I mean, I'm obviously a new councillor, so don't have a huge understanding of LOBOs. Could you just talk me through the kind of impact on the council's financial position if they do get called in? And are you aware of any other councils where things have got a little bit more developed than you said your kind of exploratory phone conversation? And then my second question is, what is the plan really for that comparatively high level of debt that's maturing in 2025? Is it the case that you kind of hope that Link's projections are accurate and the interest rates will be lower by then? And just wondering if you have an indication of what the impact will be if that isn't the case and you can't smooth that. And then just a final point of clarification really, just for my own understanding. Does the authorised borrowing limit of 590 million in 4.4, does that relate to the CFR, which is estimated at 550 million at March 2023, and that's in the table in 4.2, or is it the estimated in-year borrowing required, which is also in that table? Thank you.
Yes, thank you, Councillor. In terms of the LOBOs, if one of our providers, or indeed all of them, were to ask for repayment, we would simply refinance that from other loans, principally from the PWB, I would suggest. That could be beneficial to us in terms of, at the moment, we've got this huge spike in about 50 years' time when they all become repayable. We could smooth that out. We could have a series of loans repayable over 5-year periods, or every single year over that. And the aim then would be to try and match the repayments that we have to make in those years with the MRP that we're putting aside each year. So we're putting aside bits from revenue towards repayment of debt. It'd be nice if that matched up with when we'd actually got to repay the debt. So all nice and neat. In terms of the slight peak in 2025, well, again, if we've got the money, we'll repay it, or repay some of it. Others we will take out fresh loans, and again we might look at not doing it all to mature in one period. We might smooth it out in the same way. As for the, I think it's the capital ceiling you're referring to, the overall borrowing limit. That is based on the CFR plus a margin for what we think might happen. The CFR we would not exceed except in the short term, but it might be that we've got particular calls that mean that over on a particular day or month or short period of time, we would be over the CFR. That just sets that as an absolute.
Thank you. Yeah, just on thank you for those answers. That's really helpful. Just on the final one, I was just kind of wanting to get an understanding. I'm sorry, I don't quite understand your response. Get an understanding of the headroom. I mean, obviously, if you've got an authorised borrowing limit of 590 million, and then if the relevant figure there is the CFR at March, you've not got a lot of headroom there if it's 550 million. And I understand that you obviously need to factor in that there might be some unexpected movements. So I just wasn't sure whether that's the figure, that's the comparison of how much headroom you have, or whether the headroom is the much larger difference between the estimated in-year borrowing required, which is 139 million, compared to that authorised borrowing limit of 590 million.
The in-year borrowing requirement just refers to how much additional borrowing we think we've got to make in order to finance the capital programme. So that year's capital expenditure. Does that help?
The headroom is the 50 million or 40 million that's between the CFR and the authorised borrowing limit.
Yes.
Yeah. Okay. So you're allowing about 40 million for any kind of unexpected movements at the moment. Okay. Thank you.
It's difficult, I suppose, to go back to Tristan's thing about comparison debt levels as far as comparison with the private sector. With a public company, as part of the annual report, you always get the gearing. But that's for a private company. That's not too difficult to do because the assets they've got are mainly stock. A little bit of intangibles, but with the council, I mean, the assets we've got, it's very difficult. I know the auditors have tried, to be honest, to try and get a valuation, but we've got certain things. I mean, how do you value the contents of the museum? How do you, we've had this before, and so it is a difficult comparison. So I think it is a struggle to compare like to like. Jonathan, just a couple of comments more than question, but a bit more of a question on the first one. On page 15, the tables there in there's the bottom one. There's a line that says less repaid from receipts, grants, and contributions. The figures for 2020 to 23 and 23-24 are zero, and then going to 24-25 and 25-26, there's some sums coming in, and I can't quite get my head round about what we're talking about there, because I know for a fact that next year in January there will be substantial cash repayments coming into the authority from MDC, for instance, but that figure's still zero. So what does that actually, that line actually tell us? Because in 24-25 it says we've got 84 million coming back in. So that's the first question. Then referring to the table at 5.3, where it's good to see how the property fund investments have done, and it's good. But whilst it's correct for the end column to say the interest is zero because it doesn't, they're not interest earning assets, but they do have a yield. And whilst the total yield is shown below, which is good, but it would be, I think, best to see what the yield is on the individual investments. That will at least give members the opportunity to see whether one fund was actually performing better than the other. But working it out in total myself, just as a rough calculation, the total return on collectively on the property funds has been 31.6%, which is actually not too bad. But certainly on my own investments, equity investments, that's the way I would always work it out. I'd see what my capital gain over the years been, and also what the dividends been, and that would actually give us a better picture. also, I'm interested, again, because of my knowledge of MDC, where does the interest on the loans that are to MDC actually come into this? Could we actually class them as an investment? I don't know, because we are getting a return on that. So could we class that as an investment of which we're getting a return on, or where will it actually show up in the accounts? So
Thank you, Councillor. In terms of those repayment figures in that first table on the front page, these are assumptions where we've got short-term projects. Principally, those schemes where we are where they are borrowing in lieu of capital receipts, so where we expect to get a capital receipt. I have arbitrarily assumed that capital receipt is going to come in about 2 years after we made it, and a lot of that will be MDC. But there are other schemes where we've also, rather than put MRP aside for those schemes, we said, well, we're going to repay them from those receipts, and those are broad brush assumptions as to when those are going to come in and what that's likely to be, just to effectively make the table work, if you like, to put it on a comparative basis. That's the reason for that. I agree with your comments about what is important with the property funds is the total return that we're getting, and yes, I haven't broken that down as an annual figure in that top table at 4.3. I've sort of shown it as the cumulative return, and I've included in that table on 5.4 the returns not just in terms of capital appreciation, but in terms of the total dividends that we've paid in that. But I take on board your comments, and we'll have to consider how we're doing that.
If one fund is not performing as well as the others, at least it gives us members and officers the opportunity to look at that again.
Indeed, of course, it's not only just going to be whether an individual one fund is better than the other in a particular year. I mean, they've all got slightly different portfolios in the mix of properties they've got, and it may be that some category of property is doing better than another, and that might not sort of persist forevermore. In a few years' time, the retail warehouses might be out of fashion, and office blocks might be back in fashion, or vice versa for that. In terms of MDC, yes, I've not shown this in this table as a specific investment. The return from MDC in terms of the interest payments are included in our finance, netted off our finance and interest costs, which we budget for each year, and we have a reasonable knowledge of what that is, because we set the interest once a year on that, and we have a rough idea of what they're likely to spend, and therefore what we can expect to receive in that.
Thanks, John.
Okay.
Rupert, have you got any questions?
You probably already answered. Looking at the property investment.
Just on the, I know I'm going to come back on the property fund. It has, the dividends are good. I know I flagged that 2 years ago when I was worried about when there was a downturn at that point. I'm assuming you're keeping a very close watching brief, however, because with an interest rate rise now on the cards, are people potentially going to look elsewhere for other types of investment? And certainly, previously fixed income has been really the only place people can go to, isn't it? Because interest rates are so low, whereas I think it might be the case that people might speculate on other things, and they might move to other types of investment. I'm just wondering, in terms of the property funds, they are. I mean, I'm not suggesting we withdraw from them or anything like that. I'm just suggesting you keep a watching brief, perhaps. And I'm saying that not because you don't, because I'm sure we are. But is there? I have to rephrase this. Are there other options should you decide that you may want to withdraw? That's an open-ended question, really. Because there's always other options, isn't there? But
yes. So, well, having said that, I mean, one option that the council could decide to take is that at some point we want to divest ourselves of those investments and actually use the cash in lieu of borrowing, or even to repay some of our borrowing. That's always an option. I mean, I wouldn't advocate that the council goes and invests in speculative equity investments. Equity investments are a very useful thing, but I'm sorry, it's probably not even my place as a lowly officer to say, but it's probably not really what we should be doing with public money.
Thank you. I guess I'd just like to support Councillor Goldman's comments about maybe a little bit more granular information on the property funds. I think that would be useful. I certainly had a question around what kind of commercial property we might have exposure to, because obviously the risk is different for offices versus retail parks, and obviously the yield is different as well. And we're obviously going through some big changes with remote working and that kind of thing. So it makes some a more attractive proposition than others. So would really welcome in due course some more information about that. On the finance and interest net expenditure overspend of 700,000 that's mentioned in 5.5, just wondered what interest rate was presumed in that provisional estimate. Obviously, we've had some big changes today, and looks like a lot of changes coming in future in that regard. And then just in graph in 5.7.1, which I mean, it's quite small, but I think you kind of clarified earlier that it shows Medway's performance is kind of at the lower end of the return that's predicted in that model, and looks like it just kind of squeezes into the kind of acceptable range that's indicated. Just wondered if that prompted you to consider doing anything differently. And then just wondered, a final question, if you could talk us through Medway being the only council with zeros in the two columns in the table at 5.7.4, with kind of benchmarking compared to other councils. Just wondered sort of what that was about and what that kind of told us. Thank you.
Thank you, Councillor. Yes, I take on board what you said about property returns and the makeup of the portfolio, and better information. I'll endeavour to do that. In terms of, and forgive me if I'm missing one out. In terms of, oh yes, you asked about where I got the £700,000 from. And to be quite honest, I can't remember exactly what interest rate I used, but I used a very pessimistic rate of what was predicted at the time, which I think was probably half, if not 1% higher than is currently predicted as the worst. Was it? Yeah, that sounds quite reasonable. But also, I have assumed that what we've got in the capital programme is what we're going to spend between now and the end of the year, and we haven't done very much of that. And I have assumed that we're going to spend the whole lot between now and the end of the year. So, on average, we're going to borrow it on New Year's Day. So, I think that figure is probably pessimistic, because there's usually quite a bit of slippage in the capital programme. Things don't happen quite as quickly as we think they're going to do. So I'm trying to put what I think is the worst case scenario there. In terms of the pretty graph at 5.7.1, I would be quite happy. We were absolutely bottom of the league table there, quite frankly, because my aim in life is that we don't have loads of cash. We are a net borrower. And what I try to do is keep the borrowing position as low as I can. So I don't want pots of money sitting around. The people that do well in this graph are the people who've got tons and tons of money, and they're able to invest over a longer time horizon. They've got elaborate portfolios of you know, investments that are maturing at different dates. We've only basically got day-to-day money. And so all our money is on overnight. So you don't get a lot for that, but I try not to have lots of it, which normally isn't too much of a problem to keep that low. And that's why you got those zeros on 5.7, because our maturity days is 0. On our average weighted total time is also 0 for that very fact, because it's all overnight.
Remind colleagues as well, 'cause
Councillor Turpin.
Sorry,
Yeah,
can I just comment on that? Yes, we do have other commercial properties, but they are not a Treasury investment. Those are a policy investment, and so they count as capital expenditure. This is just what we're doing with the money that we've got available that is for Treasury. Hence, you know, the property funds come into this. The other stuff, the Pentagon and the like, do not.
Councillor Turpin.
Doesn't seem to be. Oh, that's better. Yeah, so I seem to remember in the past when I've looked at these property funds that we've got different property funds which are specialised in different areas, and they will have different returns, etc., etc. And it'd be quite interesting. And I've walked in a bit late due to issues, but you know, you've probably already mentioned this, but some of them would be more leveraged than others. Some would be in offices, some would be in retail parks, some would be in logistics. So there's a mix of that. So I'm just wondering. Then also we might get the rate of return. I think it's approximately 3%, which is not bad under the circumstances. So I'm just wondering, what's the flexibility, or are you locked into these, with a substantial penalty for getting out? You know, these are sort of, at least I would say, medium to long-term investments, not something you want to get in 1 year and out the next. So are we locked in, or is there some flexibility where you say, well, it's really going well in one area, not looking good in another area, or this fund is a bit over leveraged, we don't fancy that in a high interest rates era, so maybe go to this fund which is a bit more conservative, but it's not going to face the increased borrowing costs, so therefore our chances of return are better now on that fund.
First of all, yes, we can get out. There are notice periods, but it's normally a couple of months, 3 months, what have you. Similar to any investments in real estate investment trusts that you might have personally, you can get out of them. They are tradable. So yes, we can get out of them. The portfolios of the funds, and I don't look at them every day. The portfolios they do all tend to have a similar selection of types of properties, but they would have different weightings, and they'd be in different parts of the country. So yes, but they are very much, we consider them a long-term investment, but that's not to say that we couldn't get out of them should we wish to, or should we wish to change the weighting that we've got, take some out of one, put it in another, or even take it out and repay some loans or what have you. We have that flexibility.
Okay, thank you, John. Thank you very much for a very good report, actually, and thank you, members, for some very intriguing and in-depth questions as well. I will now take the recommendations of 10.1 of the report on page 23, which is the committee is asked to consider the report, note its contents, and note that the report will also be referred to Cabinet and full Council. Is that agreed, members? With that being agreed, the meeting is now closed. Thank you very much.